So now we have finished the first opening variant, but let us compromise or summarize the idea you need to know. The market is more or equal than 30 minutes within the value area of the previous day. It's likely that the value area will be traded through, like in the example we just went through, but you can also look for other examples. It happens very often. Of course, at some point price will go to price discovery again, like in the example, but our plan in this case always is that the value area will be traded through again of the previous day. Entry takes place at the value area high or low, depending, and the take profit is on the other side. The stop loss is the absolute high or low of the previous day from the profile or from the area we define the value area. So does not has to be the previous day, but it's day trading setups in this case, so it's most likely the previous day. Opening variant 2 is that the market opens between the absolute high of the previous day and the value area high, or opens between the value area low and the absolute low of the previous day. So we have opening here, or we have the opening here. Then when the market enters the value area very fast, either from the top or the bottom, and spends some time in there, we wait until the market trades to the VPOC of the profile and then continues to the open. From the upside also trades to the VPOC and then continues to the opening price. That is the second setup. There is take profit in this case, or entry. We're looking for entries in the POC area or VPOC area, and our take profit is the open of the day. So, what are the things we have to look for? Can we assume that heading for the previous day VPOC? So if we open outside the previous value area, but inside the previous day range or previous profile range, the target is the opening of the day, and we look for setups at the VPOC. Stop loss is immediately or above the VPOC. We will have setups, smaller setups. For example, we can have B setups in this case here. We can also have P setups where we had a fade breakout, then break in and then trade short, but we prefer B setups in a short case. In this case, we will look for P setups in the long case. Either we have a breakdown, then back break in, but those information will be part of the following slides. You can also use different setups to confirm this here, for example, trend shifts, or a combination of inside bars or volume spike and then inside bar is a very good formation for a turnover or a reversal. It will be a combination of setups you will search on the small time frame and the big picture. Big picture in this case, not really, because we talk about time frame of a day, but you can apply it to any time frame. It is a combination that you have a plan what the price will do, and then you will try to optimize your performance by going to lower time frames and looking for setups and further confirmation.